broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you from the CNBC-TV18 Motilal Oswal studios. And we are one day ahead into the week because yesterday was a market holiday, so we're coming out of a longer weekend. I'm Prashant, with me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant.
Morning.
Good morning, Nigel. And what a lovely long weekend, right? I mean, the weather was amazing yesterday, day before. It was so cloudy. Of course, there were rains as well. And then you wake up this morning and you have only 4 days left for the week to end. So you can't ask for anything more, perhaps.
Absolutely. And it's, one of the last longer weekends that we have in this year, 2023. Then you have Christmas weekend. That's the next long weekend. So good times ahead, guys.
And when you said this year, I just realized that the year has just flown by, right?
That's
I mean, already at the end of the year. And it's festive season. You get into, Thanksgiving is done. You get into Christmas.
My highlight is the weather is turned now, right? The mornings are nippy and it's not hot anymore. So I think it adds a zing to it. Well, let's just quickly turn and tell you in terms of what you need to know, because we're coming out of a 3-day weekend. Not that it's been hugely eventful in terms of news flow or price action or anything of that sort, but this is what, happened. Just to kind of recap last week, it was absolutely directionless. All of last week was directionless. The Nifty spent most of the week in a 200, 250 odd point range. So very range bound in that particular sense. And if you look at overnight, what happened? So we had half a day of trade on Friday for US, but that was absolutely flat, almost unchanged. So I'm not going to bother with that. Last night, again, it was flattish. I mean, choppy start of the week, you can say. The S&P was down about 0.25%. The NASDAQ on your screen was very, very flattish as well. But this, last night's change not hide what sort of fantastic tidings November has brought for US markets. The S&P is up 9% in the month of November as we wrap out the month now. And the NASDAQ is up 11%. So this is actually one of the best Novembers going back, I think, a year and a half or so for a few of these indices. So it's been great for the US. In terms of data last night, new home sales actually contracted. Actually, prices also fell. And the fall was more than what was expected. So data, especially on the home side, seems to be softening a little bit. The 10-year, on Friday, the 10-year, by the way, had gone up about 6 or 7 basis points. Last night, it came off about 9 basis points. So from the time, effectively for us, the 10-year has moved about 2 basis points. The last close we saw was 4.4. We are at about 4.38. So not very much really to react to in terms of incremental change because you're coming out of a holiday. Oil is near $80 a barrel, so it's steady. I'll come to sort of Qs in a bit because there is Q for oil later this week. Gold prices, they hit a 6-month high and they're above the $2,000 per ounce mark now. As I said, events this week, the important ones, you got the OPEC Plus meeting. This was supposed to happen last Sunday. It did not happen, and now it will happen on Thursday. So this is number one. You get core PCE inflation data on Thursday as well. And then there is, Fed Chair Powell's speech, which comes in on Friday. Between now and Friday, there is Powell's speech. There'll be other Fed members who will be speaking. But, the big one, of course, is the Fed Chair himself. I just want to say this. It seems like, and we've been saying this again and again, the narrative has shifted quite substantially. You can see this in the way US markets have performed in the month of November. Markets are worrying less about higher for longer kind of scenario. Instead, they are embracing more dovish outcomes, right? Soft landing and so on and so forth. So the point I'm making is even if data comes in a little hot, it's unlikely that the market is going to worry and sell off in any substantial way. If it does that, more likely than not, participants will use that and look at that as a bit of a dip buying opportunity. Now, just to circle all of this back and look at the market here, as I said, it's been absolutely range bound, but we got to tackle the levels, very near-term levels. Support comes in at about 19,670, which is last week's low, and then at about 19,575, which is the 20-week moving average. So I'm looking at very near-term levels. Resistance, and this is a level we put out last couple of, the whole of last week, comes in at 19,875. It was the recent high that the Nifty had seen, and we've not been able to take that out on the upside. The Nifty Bank, and we kind of have said that the Nifty Bank has been the weaker of the two indices for a while now. Last week, though, it actually ended higher. The weekly close was positive for the Nifty Bank, unlike what it was for the Nifty. So we need to see if, that thesis is changing, that the Nifty Bank wants to actually move higher. And I think we'll need a few more days of the kind of action we've seen last week to prove that. Resistance for the Nifty Bank comes in at the 40-day exponential moving average, which comes in at 43,828. We left off at about 43,770. So this is very, very close by. And support for the Nifty Bank then comes in at 43,567, which is the 20-day moving average on the downside. So as I said, the Nifty Bank, I mean, in terms of by way of price action, needs to prove that the positive close of last week means that it does not want to sell off. It was looking as we entered last week, and it wants to actually go higher. The big cue, I mean, from our perspective, of course, is the state election results. 4 days of trade, and then we get into the weekend. And on Sunday, that is the 3rd of December, we get election results for the 5 states which went to polls. The biggest, I mean, some of the big Hindi heartland states like Madhya Pradesh, there'll be Rajasthan, there'll be Chhattisgarh, Telangana, Mizoram, etc. So that's going to be the really big one. Something we will kind of get into and discuss more as the week goes on. Sonia.
Absolutely. So, this week is going to be a volatile one because of all the, cues that we have, right? I mean, whatever little is left of the week, the 4 days of the week, you have the exit polls on Thursday, and then you have the final results on Sunday. So perhaps the market is going to be a little volatile in anticipation of the results that come out on Sunday. In that context, the last couple of days, at least on Friday, it was largely a range-bound day of trade. The flows have also been on the muted side, although there has been strong buying from foreign investors. So we'll come to that in a bit. But before that, I think the broader market outperformance is something that I'm looking at. So while the headline index is absolutely flat, facing resistance at 19,800, it's the broader markets that may continue to outperform. And within that, many pockets, right? Insurance stocks saw big moves on Friday. You had some of the defense names that saw big moves as well. Gold loan companies may come back in focus because of the big move that we've seen in gold lately, like Manappuram, Muthoot, etc. So these are a couple of pockets that may continue to see traction. These are, the larger triggers, of course, are F&O expiry, there's the MSCI rebalance, and there's the state election outcome. So all eyes are going to be on that. But coming back to flows, both FIIs and DIIs bought in the cash markets on Friday. FIIs bought about 2,600 crores and DIIs bought 130 crores or so. Brent crude prices have also cooled off to $80 a barrel ahead of the OPEC meet. So, that's another positive for our own markets. The GIFT Nifty is suggesting a positive start, but yes, could be a bit volatile as you have large political announcements through the course of the week.
Well, that's right. That's one big trigger, Sonia. And the other trigger, I think, is that there have been so many IPOs that a lot of these mid and small caps, the money has got drained out. Now you'll get rejections. Only few will get allotment in IR&DA or whether it's, the Tata Tech as well. So that money comes back into the accounts and that can be deployed provided we get a favorable outcome in terms of the state elections. Now, focusing on the headline index, the Nifty Bank, that's showing signs of life. In the last 2 sessions, it's outperformed the Nifty. The Nifty is more or less flattish. The Nifty Bank is up 0.7%. In the last 7 out of 8 sessions, we have gone to around 19,800, but we have failed to decisively conquer that particular level. So if we just pull up the chart on a day-to-day basis, we're visiting that 19,800 odd mark, but that 19,850 to 19,875, that's being a bit of a resistance zone, and that chart comes up for you on the screen. Now, it's a monthly as well as weekly expiry that will play out for the Nifty. That's on this Thursday, the November series, we pull the curtains down on there. So the 19,800 call, 19,800 put as well, that it appears as a short straddle that's taking place out there. What's that? Well, you pocket the premium on the same strike, that's the 19,800 put and the 19,800 call. And on an average, the premium out there is around 200 rupees. So basically, 19,800 plus 200, which will give you a mark of around 20,000, and minus 200, so 19,600. It appears going by this strategy, most traders are bracing for this broad 400-point range. That's a short straddle at around the 19,800 odd mark. But the Nifty Bank, that deserves special mention, because that's showing signs of life in the last few sessions. And even if you look at the options data, the 43,700 put, 43,800 put, both of them were fairly active. Big open interest build up is what we've seen out there, which brings us to the levels. Since you're seeing writing at those levels, the 20 and the 200 EMA, well, that comes in the vicinity of around that 43,350 to around 43,450. So that becomes a crucial support zone going by the options data and going by the 20 as well as the 200 EMA. While on the upside, the 50 DMA comes in at around the 44,050 odd mark, the bulls will want to get closer to that mark, because then, in fact, you could see a bit of a short covering bounce that plays out. But that's the broad range for the Nifty Bank. You want it to continue to outperform because that helps the Nifty. For today, the Nifty Financial Services Index, well, that plays out, the weekly expiry, so we'll have to keep an eye out on that one. For starters, the Gift Nifty suggests that we start off with the green. We need to build onto that and decisively conquer the 19,800 mark.
Okay, well, before we start, let's tell you what's lined up in the first half hour of the show. We'll get you updates from the markets across the globe. Fook Hin Yap of Standard Chartered Bank will be joining in to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At around 8:30, we'll do a fundamental stock analysis with Siddharth Khemka of Motilal Oswal Financial Services. But first up on the equities front, Vikas Jain of CLSA says a 32 to 38% rise in small cap and mid cap benchmarks in the year so far is taking them close to a record calendar year outperformance to the Nifty. This has raised the relative valuations of small and mid caps, and further outperformance may not be easy. A notably divergent move in small and large cap banks has taken the valuation premium of small and mid cap banks to big banks to an 8-year high. FIIs and domestic mutual funds are overweight of banks are also near record lows, while CLSA's growth and valuation analysis find banks as the most attractive within the Nifty. Vikas adds that banks remain the biggest overweight in CLSA's India-focused portfolio.
All right, let's get you some money market views now. The rupee, Abhishek Goenka of IFA Global Research says that the rupee has underperformed massively amid recent dollar weakness. While the rupee has been almost unchanged against the dollar, it has weakened about 3 to 4% against the euro, pound and the yuan. He expects the rupee to underperform in overall dollar weakness and outperform during periods of overall dollar strength. This should keep volatility contained. Over the medium term, he expects the currency to trade between 82.7 to 83.7 to the USD.
And on the bonds, Ajay Magnolia of JM Financial says yields are fluctuating in a narrow range influenced by volatility in US Treasuries and oil prices in the absence of any domestic clues. This week, he adds the focus is on GDP data, which is anticipated to be lower than last quarter. He says traders are concerned about the open market operations sales, but find some comfort in the fact that deficit in systemic liquidity may refrain the central bank from any such move. He also says in the absence of any major cues for the day, he expects the 10-year benchmark bond yield to trade in a range of 7.24 to 7.29% for the day.
All right, well, that's views coming through at this point in time. We have Fook Hin Yap, Senior Investment Strategist at Standard Chartered, now joining in to take some questions. Fook, great to have you with us here. Thank you very much for your time. It's been great, right? I mean, for US stocks, November has been absolutely great. Here in India, though, things have been more ranged lately. And there is a bit of a divergence as well. The Nifty Bank, which is an important, banks and financials are about 35% of the Nifty weight. They refuse to perform. Although towards the end of last week, there were some signs of life there. The Nifty is a couple of percentage points from all-time highs. What's the most likely roadmap from here for Indian stocks, Fook, according to you?
Yeah, thanks very much. Thanks for having me here. So, I mean, on India, we take a 6 to 12-month view in terms of our advice to clients. And I mean, for India, we have it as a neutral within Asia ex-Japan. It's more on a relative basis. We want to be diversified across Asia ex-Japan. And it's just on a relative basis. I mean, look, the growth outlook is strong for the medium term. We've got earnings growth 14%, 17% for the next 2 years. And yeah, I mean, within India, though, the sectors that we do prefer are actually financials, industrials, and healthcare. So financials, as you mentioned, which is what is of interest here, we think, taking a 6 to 12-month view, the economic growth is still strong. That's still going to be supportive for your retail loan growth, for your corporate loans growth. The balance sheets are strong. So in terms of the provisions and the bad loans which are out there, we think it's quite benign. And valuations are attractive. So we do have an overweight view for financials in India. But compared to the rest of the Asian markets, like I said, we are looking to be diversified across Asia ex-Japan. And so that means being allocated across China, India, Korea, as well as Taiwan, and to be diversified. Each market has their own pros and cons.
Sure. Fook, hi, good morning, and thanks for joining us on the show, and greetings of the season to you and your entire team at Standard Chartered. This has been a really good year for India. India has given 10% returns. compared to peers, do you think India could continue to outperform in 2024?
Yeah, I mean, we're working on our outlook at the moment for next year. But, the house view at the moment, like I said, is to be diversified. Like I said, we do have a neutral for India compared to Asia and Japan. And within Asia, actually, the market we do like is still Japan. We think the investor flows, if you look at it since 2015, the cumulative flows are still negative, even though it's been picking up. So we still see a bit of pickup there. So within Asia, actually, our preferred market is Japan, where we still see investor flows coming up as a catching up, and the valuations are still attractive and the corporate governance improving. So outside of Japan, though, I was taking our view to be a bit more diversified. Look, India has done very well. I say, year to date, it's done very well. But that means that if you look at other markets like China, which has underperformed significantly, a little bit of good news can be very good for the market. So that's why we're looking at the risk reward of the different markets and taking a more of a diversified approach across Asia and Japan.
Hi, folks. Morning. So, at current reckoning, going by the outperformance of India and despite good earnings growth as well as good economic data, at current reckoning in the near term, you would prefer China over India?
I know. It would be neutral on China and neutral on India as well. Yeah. So we're taking a more diversified approach. Thanks.
Diversified approach. Yeah, you mentioned last time as well that Japan was the market you liked from Asia, but from the emerging markets, you want to diversify across Korea, Taiwan, India, as well as China. With regard to the US Fed, I think, you're in the camp that believes we're going to see more than a couple of rate cuts from the Fed in 2024. How many are you working with? And, the problem is that those rate hikes may be done and dusted, but the impact on the US economy could come in 2024, which could hurt the global economy as well. How do you view this?
Yeah, you're right. I mean, we are looking at 3 rate hikes by September of next year. And we think that is the Fed's reaction function as growth slows next year. We think the Fed will respond with rate cuts. And as you mentioned, there are very long and variable lags with monetary policy, as the saying goes. So yeah, a lot of that impact will take time to filter through. But we focus on the market at the moment. The market is not really pricing that in. We think the narrative of a soft landing has been getting louder and louder. And so the market at the moment are quite positive. And it's taking the relief that at the moment rate hikes are done. So that's been very helpful for the market. It's bounced a lot since October because of the narrative that rate hikes are done. We think positioning is still very low in terms of the investor positioning. There's still cash from retail and institutional investors waiting to be deployed. And so we think that that is supportive in the near term for the market, for the equity market to continue grinding higher. We do point out, though, recently that the S&P 500 especially is coming into technical resistance at 4607. It's tested this 4 times in the last 2 years. So as it approaches this level, the likelihood of some kind of consolidation rises a little bit. But the positioning is still positive for the market in the near term to go higher. In terms of what happens to the economy next year, I think the rates are still high, and that's something that still has to be digested. But bear in mind, the U.S. equities is very much driven by your large cap global technology companies, which can continue to do well, even the domestic economy is a bit weaker.
Okay, so just one final question. You said that the rate hikes have come to an end, but I think now the narrative has changed to rate cuts in the second half of the fiscal, right? Of the new calendar year, that is. Are you in that same camp?
Yeah. So we do see a rate cut to come in by the middle of next year from the Fed as it responds to the weakening of growth, as inflation is coming off and it's under control. So we think the Fed will respond to weaker growth with rate cuts. And we do see 3 rate cuts by September of next year.
Okay, 3 rate cuts by September of next year. Fook, thanks a lot for joining in. Appreciate your thoughts. Perhaps that's what risky assets are pricing in as well with the strong move that we've seen lately. Let's slip into a quick break. On the other side of the break, our list of top 10 stocks is lined up with our entire research team. Stay with us. Welcome back to Bazaar Morning Call. As promised, now we have our entire team joining in to help us with all the stocks you need to watch out for. There's lots happening with Paytm. So Nimesh is joining in first up to tell us the latest on that. Nimesh, over to you.
Hi, morning, Sonia. So, I'd given enough hint on Friday itself that who the potential seller is likely to be, and indeed it turned out to be. So, Berkshire Hathaway sold its entire 2.5% stake in Paytm via block deal on Friday. The buyers include most of the FISO, which is why the FI number on Friday looks very large. But so it's a clean out trade from Berkshire Hathaway. They've sold at a loss in Paytm after holding for 6 years. Now the further implication is because of the exit from Berkshire Hathaway, the free float for Paytm will go up, which means that possibly in the next review of MSCI, the weight for Paytm will also increase. So that's a positive thing to read into. But the fact that I'll go with the green because it's a clean out trade and Berkshire has sold out its entire stake in Paytm on Friday.
We did give a hint, Nimesh, did we not? Large investor, marquee investor, one of the largest sitting on a huge pile of cash. So yeah, bang on. Congratulations, Nimesh, on that.
Thanks.
Well, let's talk about the SEBI board meet which happened, and there was a lot of expectation about what can happen, what not, potentially maybe approved at that board meeting. And one of the things was regarding holding companies. Yash has got details. Yash, morning.
Well, Prashant, good morning. So, of course, disappointment as far as these holding companies are concerned. It was widely anticipated that market regulator SEBI would finally give its approval to those voluntary delisting regulations, under which an important part was about, delisting of the holding companies, which aimed at giving the right value to these holding companies, which generally trade at a discount. Contrary to that expectation, there was no approval which came for the voluntary delisting regulations. And these stocks, a lot of these holding companies, be it BBTC, Maharashtra Scooter, Pilani Investments, Tata Investments, were running. There was a significant addition to the market cap for some of these companies in the last few weeks on expectations of these regulations to come in. There is no approval on that one, and SEBI has said that it will have to go back, reassess more data, and if required, pass another consultation paper before it finally gives shapes to these, delisting regulations.
Okay, all right. Thanks a lot, Yash, for giving us an update on that front. Well, I'm looking at two cement stocks. One is Kesoram Industries and the other is JK Cement. Let's start off with Kesoram Industries first. There are two pieces of news out here. One is they've responded to a CNBC-TV18 exclusive, which we reported on November 24th, that it's likely that, Kesoram Industries falls into Ultratech Cement, and we've given you, how things could work out, because as of now, Mr. K.M. Birla, he owns part stake, his entities hold part stake in Kesoram Industries as of now. They've responded, they said that they're currently exploring fundraising avenues with regard to repayment, retirement of debt that's due next year. But they've not taken any decision that warrants any kind of disclosure. So that's what they've said on that piece. The second part is yesterday they've put out that they'll be having a board meeting on Thursday, and they're going to be withdrawing the scheme of arrangement that was announced on May 22nd. That's with regard to separating the rayon business from the cement business. So they're withdrawing that proposal. They also go on to say that they're going to be looking at possible options of debt repayment as well as retirement with regard to those NCDs. The problem out here is that they were borrowing at close to 19%. So they want to repay or, retire this particular debt. How do they do it is going to be very, very important. So that's one stock. The other one is JK Cement. They've commenced their grinding unit of around 1.5 million tons odd. That's on expected lines. It's at Madhya Pradesh. So their capacity, as they have been saying, it's gradually moving towards 25 million tons by 2025. So we'll have to keep an eye out on that one. Both of them, expect them to react positively.
Okay, keep an eye out on these stocks. But there's Fortis and Fortis Malar also in focus. Ekta's here to give us the latest on that. Ekta, morning.
Morning. Well, I expect both of the stocks to be in the green because it is positive news. I'll get to that in just a bit. But the news is that Fortis will be divesting its entire 62.7% stake in Fortis Malar to MGM Healthcare, which is a private hospital company, for 128 crores in an all-cash deal. Now, Fortis Malar is a 140-bed hospital in Chennai. It is a listed company. The company had some unresolved legacy issues which Fortis was facing in the company, which constrained further investments. So Fortis now now is going to be divesting all of the hospitals which they feel are underperforming. This is the second hospital that they've divested just in the past 2 quarters. The first one was another one which was in Chennai for 152 odd crores. So maybe hospital margins would improve, hence it's a positive for Fortis because they will also be getting cash into their books. MGM Healthcare, it's a South-based hospital chain. Their bed count is going to rise to 800 in Chennai. So maybe this would be positive for Fortis Malar, considering that it would be going into stronger hands which are focused in Chennai. So I expect both stocks to probably be in the green on account of this news today.
All right, Ekta, thanks very much for that. Well, let's focus on a few other names, and MapmyIndia is one of them, and there is Sterlite Tech as well. Reema's got details here. Reema, morning.
Hi, good morning. Sorry. So MapmyIndia board has approved a fundraise to the tune of 500 crore rupees via a QIP. As of September, the company already had cash in books close to 518 crores. So with this, the total cash kitty will rise to above 1,000 crore rupees. The utilization of the proceeds will be important. Will it be for an acquisition? Because in FY24, the company has committed to grow its top line by 40%. But in the first half of the year, the company has only seen a growth of 28%. So it boils down to the company delivering an over 50% growth in the second half of the year. So MapmyIndia fundraise QIP 500 crore rupees. The second stock is Sterlite Technology or STL, where there's negative news because the company has lost a legal dispute because of which they will have to pay financial damages to the tune of close to about $3 million. This case is against a company called Shin-Etsu, where STL was supposed to buy certain products from Shin-Etsu at a particular price. But during COVID, in the months of April and May, Sterlite Technology, STL, evoked force majeure, and they said we cannot buy those, promised, products in the what was stated in the contract, and therefore this appeal has been going back and forth for the last 3 or 4 years. But now STL has lost the appeal in the Supreme Court, and as per the award, STL has to pay damages of about $2.1 million plus a simple interest of more than 5% for the period and certain costs. In an earlier intimation about this legal dispute, the company had totally indicated that the damages is close to about $3.1 million. So we assume that's going to be the potential hit for STL. Back to you.
Okay, thanks a lot for that. Well, let's go across to Sonal. She's tracking Cello World and Sirma SGS. Sonal, morning.
Good morning, Sonia. Let me start with Sirma SGS first. The stock has been doing really well. Now the company has incorporated a wholly owned subsidiary. The company is named Sirma Semicon Private Limited. This will carry on the business of designing and manufacturing the buyers, sellers, assembly, exporters, importers to make memory chips, memory modules, PCB assemblies and other storage products, just an extension of the current business that the company is in as well. For Cello World, it's their first earning after listing as well. They've given quarter-on-quarter numbers, and while they have seen a 4% revenue growth to come in at 489 crore rupees, their EBITDA has been largely flat at 120 crore rupees. Margins have declined by 60 basis points, but profits have increased by 4%. So these two stocks will be on our radar today.
Okay, all right. Thanks a lot for that, Sonal. Well, let's do a quick recap of all the top stocks that we just covered for you. The ones with positive news flow. First up, we have Paytm, Keystone Industries, JK Cement. We have Fortis Healthcare, Fortis Malar Hospitals, CE Info Systems, and Sirma SG. Well, stocks with negative news flow, well, they include holding companies, STL, and Cello World. Okay, well, those are all the top stocks that we're looking at, but there are some brokerage notes as well that have come in early this morning. Hormuz has gone through them. He joins us to fill us in with the list. Morning, Hormuz.
Morning, Nigel. And I'll start off with one of the outperformers of the year, that is BSE, where Jefferies has initiated coverage with a buy rating and a price target of 2,700 rupees. And it says that it can leverage macro tailwinds and some derivative headway to report a 150% earnings growth in FY24. And it also says that it expects the derivative segment to be 35% of BSE's revenue in FY25. Now, remember, the stock, as I said, has up nearly 300% in 2023. Next up is also Jefferies that has a buy rating on L&T, the price target of 3,400 rupees, and it says that a capex cycle traction and completion of the legacy low margin projects will drive upside in the next 6 to 12 months for the stock. But it says that the muted second half of FY24 guidance that the company has issued is a near-term dampener for the stock. But they're saying that the ESG upgrade, any ESG upgrade that comes in, is an added sweetener, and that the management is working with ESG agencies to tell them more about their defense exposure as well.
And lastly, since we spoke about Fortis, Goldman Sachs has come out with a note. It has a buy rating, a price target of 400 rupees. It says that this divestment marks Fortis's exit from the Chennai market, and it is a significant step towards their portfolio rationalization. And it still has 4 to 5 more facilities that are operating inefficiently, and some of which that the company may end up divesting in the near future. And lastly, the Fortis also plans on adding over 1,400 beds over the next 3 to 4 years in the markets like Delhi, NCR and Punjab. Back to you.
Okay, thanks a lot for that. So lots of interesting brokerage ideas over there. But let's talk about the other big positive for our markets, which is the fall in Brent crude prices. Brent is now at $80 a barrel. Manisha Gupta is here to give us a roundup of all the action from the commodity markets. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, we had seen the Brent fall below 80 as well. 78 has been the low for the month of November, but some stability now coming in. And this is ahead of the OPEC and allies meeting, which is on 30th of November, with expectation that Saudi Arabia and Russia could extend voluntary supply cuts into 2024 as well. But we all know that some OPEC members have increased output. There is record high U.S. production, surging China inventories, and that is keeping the prices in check. But one sector which has continued to run up for this month as well has been the precious metals. You have the gold prices now trading at $2,015 an ounce, far away from an all-time high, especially with the US dollar index trading at a 3-month low. That is absolutely offering support for gold, silver, copper is trading in positive, and so are various other industrial metals.
Okay, Manisha, thank you very much. We'll keep coming back to you for more. This is an important week, especially for oil, with that OPEC meeting scheduled for Thursday. We'll take a quick commercial break here. Siddharth Khemka of Motilal Oswal Financial Services will join in to take us through some fundamental stock analysis. Later, we'll also be talking to our technical experts for trade setups. Stay tuned. All of that coming up.
Four walls don't.
Welcome back. Hope you're having a good morning. Well, we told you all the stocks that you need to track. Let's get some fundamental analysis going on some of them. Siddharth Khemka, the head retail research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Morning. Good to see you in as always. Well, Sid, you know, we have a couple of management joining from the real estate sector later on the show. What's your take as a brokerage house? What do you all have coverage on? I think you all initiated coverage as well on a couple of real estate stocks. So tell us more. What's the preference out there?
Yeah, very good morning, Nigel. If you look at the real estate sector as a whole, we are witnessing a strong uptick in demand. And based on various industry reports, the top 7 cities and the top 9 cities, they have been recording decadal high sales in terms of units. We have also seen a sharp surge, especially in the premium segment or the luxury segment of the residential market. And you would have heard news flows of how new launches in the premium and luxury segment have been lapped up within days of their launch. So that makes us very positive on the overall sector. And mind it, this demand uptick has happened in an environment where the interest rates have cycle has peaked out. Now from here, if any correction in the interest rates, cut in the interest rates in the coming year, will only boost the demand for the real estate back. In that space, there are some certain micro markets that we are very positive on. For example, the Mumbai region is something that we are very positive with the strong demand and a controlled supply that has helped retain prices. With raw material prices being under control, margins have been pretty good. And within that space, we like a Godrej Properties, which is our preferred pick, followed by Lodha. And we recently initiated coverage on another Mumbai-based real estate player called Sunteck Realty. It is one of the leading players in the Mumbai metropolitan region. It has a luxury presence across price points with a proven execution track record. And to look at it, if you look at some of these new projects, 3 of its new projects launches have resulted in 22% pre-sales CAGR during the last 3-4 years. And we expect this strong momentum to continue. We are expecting 25% CAGR over the next 2-3 years with the company gearing up for 2-3 more new launches. We are also expecting strong balance sheet, debt to equity of just 0.1x, robust cash flows, cumulative operating cash flows of 16 billion over the next 3 years. Hence, we believe that stock should also do well. We have a target price of 640 on Suntech, which is a decent upside from current levels.
Okay. Siddharth, hi, good morning and thanks for joining in. I wanted your thoughts on some of these Indian exchanges, right? Like BSE, for example. There's a brokerage report from Jefferies this morning where they've initiated buy and they have a big target price, 2,700. And they talk about how financialization of savings is leading to a big, move towards BSE. But the stock has rallied substantially this year already. Do you see further upsides?
Sonia, so I would say that, yes, BSE is something that we cover. We like the stock. The company has definitely benefited from the retailization as well as financialization of savings. But one key point that has helped BSE in the last couple of months is the launch of the weekly expiry sensex on Friday and BankX on Mondays. With the sensex expiry on Fridays, BSE has now about 7 to 8% market share in the F&O segment, where it was almost not present some few months back itself. So that gives a good growth for entry into a good growth segment, the index options market for BSE, which is driving the share price. So after this run-up, we have a target price of 2250, which gives very little upside or room for upside from current levels. But as I said, the business model is very good. The entry into the index options market will further drive growth. They already have key strengths in the mutual fund, the MF Star platform that they have, and some of the other segments where they are definitely doing very good.
Okay, so that seems like a stock which has been on steroids, although it did come off. From 2,500 levels, it's come off a little bit over the last few trading days or so. Just a quick word on Cipla, Siddharth. If you have looked at it, a big price damage, but if you are reading through a lot of what analysts are saying, there is real earnings risk as well, which is materializing, and lots of earnings cuts, price targets being brought lower. Any thoughts on this one?
Yeah, Prashant, so I think that is definitely negative. The warning letter for the Pithampur facility and the kind of the warning that has come, it highlights issues related to the inadequate investigation related to market compliance for its products, documentation and field alert reward violation. So these are things which definitely creates a negative sentiment for the market. However, if you look at the company has been saying that they have been filing products from some of the other plants, definitely there is a risk to the earnings estimate especially from these plants and the certain products that they have been producing from this facility, which will take some time for them to shift to other plants. And there is as I said, there's a negative sentiment around the kind of the warning letter that has come. So we had been positive about it, but I think with this warning letter, there is some estimates cut from our side as well. And we'll need to see how the company responds to these issues that has been raised by US FDA.
Okay, let's do one thing. Let's take a short commercial break. On the other side of the break, we have a brand new trading session coming up in just a bit. So Anuj will be joining in to give us a quick trade setup. Post that, we'll also bring you some top stock ideas for the day from our technical and F&O experts. Stay tuned.
Okay, welcome back. 15 minutes to go for the pre-open session. Anuj is standing by with a quick check on things in terms of how the setup is looking like. Anuj, 4-day week left, but how are things looking?
Yes, morning, Prashant. 4 days left. And of course, this is the monthly expiry as well, so the big one. And in fact, all eyes on Thursday because, a lot of things are aligned towards Thursday. You have the monthly options expiry of both Nifty and Bank Nifty. The exit polls come out on Thursday. And of course, there's an OPEC Plus meeting as well on Thursday, which will decide on the potential output cut. So a lot lined up. The market's been doing well. And FIs are still short, 78% net short position. So if there's no negative news, short covering can be big. We've already seen a 1,000-point rally, by the way, in this series. In fact, the numbers would come for you. The last series ended at 18,857. And the low was made on the day one itself. Whenever you get the low or the high of the series on day one, that normally is the trending series, which ends on the other side. And the high so far has been 19,875, which was last Thursday. The close can be anyone's guess, but my estimate is it should be at least above 19,875. That number is back in focus. We've hit that twice. First on 16th November, then on 23rd November. The only issue stopping this index is this exit poll overhang. But one thing which is now going in market's favor is that the Bank Nifty for last 2 days has been ending at day's high and has been outperforming. If that bottoms out, that's the only piece left in this puzzle for the market to go to all-time high. That could be a big positive. The other thing is that regardless of where the Nifty is, portfolios have done well this month. Look at the mid-cap index, 8% up. Small-cap index, 9.3% up. Everyone's saying that these are overheated indices, but it's not stopping them, and most of these indices still doing well. Now, coming for day trade on the Nifty, today's outlook, the first support is 19,768, Friday's low, and the biggest support is 19,690, options-based. On the upside, the first resistance comes in at 19,875, the series high, and the bigger resistance is 20,010, which is based on options. On the Bank Nifty, the numbers would come up for you, both in terms of the support, and also in the next plate, you'll see the resistance levels, 44,100 and 44,420.
Also, Anuj, you know, this broader market outperformance you spoke about is testimony to the fact that so many sectors are coming back in a big way, right? Whether it's insurance companies, whether it's real estate, renewable energy. So the market is sort of full of ideas right now.
Absolutely. And if the market is not full of ideas, in that case, the market is just, looking at IPOs. I mean, just look at what happened to Tata Tech's IPO, for example. I think on that large IPO to get 75 times subscriptions, or IRIDA for that matter. In fact, all 5 IPOs which came out, look at, sectors like defense, home improvement, all these, sectors doing well. So I think there's a lot of money coming in the market. And if that morning report is right, about that pension fund investments as well, you'll have a lot of money chasing stocks.
Okay, thanks a lot for that. Perhaps a good festive season, that Santa Claus rally that everyone looks forward to. But Siddharth Khemka is still with us. Siddharth, I wanted your thoughts on the Tata Tech IPO that Anuj was talking about. Very strong subscription, but the bigger story perhaps is post-listing, right? I mean, the expectation is that, the strength in the business is something that could continue. It's in a growing space as well, the electric vehicle space. Is this a stock that you would buy post-listing?
Sonia, yeah. So I think if you look at the business model, definitely it's a pure play ER&D space where we have seen a lot of interest in the existing stocks in the market as well. And with the kind of valuation they came with the IPO, I think the kind of oversubscription had to be there. And to add to it, a Tata IPO after 19 years. So the stars were aligned for this IPO to see the kind of oversubscription, and you have these flows which you and Anuj just talked about. So I think, yes, definitely we are positive. But with the listing, post-listing, the business model definitely doesn't change. Valuation is something that one needs to be cognizant about. And there will be opportunities in the market to get in the stock at the right valuations because the growth is pretty strong. It's placed in the EV segment, which is at the sunrise sector, which will see a lot of growth. So definitely a positive view. But as I said, one definitely needs to be cognizant at the valuation at one gets into the stock.
Sid, what about the auto space? There's plenty of excitement out there. We'll be getting the auto sales numbers as well by the end of this week. How are you all viewing that pocket, and what's the preference out there?
Yeah, Nigel. So I think auto has been one sector which has been buzzing a lot, even in the quarterly results. 2 sectors that clearly came out with strong numbers: A, the banking BFSI space, and 2, the automobile space. So there we have seen news flows about this strong festive demand this time around, right from the 2-wheelers to the passenger vehicles. So I think we believe that the demand would continue. Supply chain issues have been resolved. Costs have come down. and that is one big factor which has helped improve margins and report stronger earnings growth for auto stocks. Going forward, what we believe that we are witnessing a strong demand, especially in the two-wheeler segment, wherein we anticipate high growth, and that is where we are changing our preference from passenger vehicles, which was our preferred segment within the auto space, to now two-wheelers being our preferred space within the automobiles, followed by MHCVs. Passenger vehicles are showing signs of growth moderating while the mix continues to improve. Mix towards SUVs have increased, and that has led to stronger growth as well as margins. But if you look at, as I said, within the two-wheeler space, we like Hero Moto. The company reported very strong, its highest ever festive sales of over 14 lakh two-wheelers during the 32-day festive period, start of the Navratri and end of Diwali. The company is also looking at premium segment production for the Harley Davidson and the Charisma, which is in the premium segment. And the number of outlets have also currently is at 200 for the premium segment, and it targets 500 outlets. So we see a strong growth. But in the core business, Hero continues to do well, has seen good demand in the festive season. Now that marriage season is starting up, we expect demand for Hero Moto in the marriage season would also be pretty strong. And hence, I think that is one stock which can do really well within the two-wheeler space. We have a target price of 3850, about 15% upside from current levels.
Okay, we'll come back to you. I do want your thoughts also on this growing renewable energy space and the fact that India is doing a lot in this energy transition space. So, all the stocks that are in focus, I want your thoughts on that. But in a bit, in the meantime, we have Mitesh Thakkar and Sudarshan Sukhani also joining in to tell us how to approach trade. Gentlemen, morning to both of you. Sudarshan, it's that sort of feeling where you're there but not there just yet. So the 20,000 mark once again has become a bit elusive for the market. But do you think it's just a matter of time before we get there? And is your bias on the upside?
Yeah, good morning. That was a very nice presentation. There but not there. All right, so yeah, I think we'll be there. It's a matter of time. Now the markets don't have to oblige us by going up every day. But look at the trend behind this trading range that has developed. We had a 1,000-point rally, and there is nothing to suggest that the rally is dissipating or ending, or there is something else happening. The worldwide rally and then the Christmas rally all are joining together. So have patience, buy on dips, let the Nifty take its own time to reach 20,000 or even 20,000 plus. And then the Bank Nifty finally seems to be getting its act together. If the Bank Nifty starts becoming supportive, then that breakout which we are all waiting for will inevitably happen. Be long in the Nifty.
Okay, got that. Be long in the Nifty. That's the call coming from Sudarshan. Let's get in Mitesh as well into the discussion. Hi, Mitesh. Morning. What's your take? We seem to be in that range. 7 out of last 8 sessions. We've gone past the 19,800, but we couldn't decisively conquer it. Today, going by the GIFT Nifty, we can possibly do that. Your take?
Morning, Nigel. Last entire week, we held the view that markets will consolidate and you will see supply emerge at 19,850, 875 zones, while on the downside, 19,600, 620 should be the floor, though I think we, remained above 19,700 for majority of the week. Having said that, I think the structure is definitely positive, but the key burst of momentum will come in once we start getting past 19,875. And that should see us try the 20,000 mark again very soon. So I think the way I'll approach is that post the gap up opening, if we see continuation and the Nifty starts to sustain about 19,875, then a fresh long on the index can be taken. But otherwise, we are trading with long bias on individual stocks. So the bias is clearly on the positive side, but a trade on the Nifty will be triggered if we start getting past 19,875 only.
All right. What about individual stocks? What are we looking at this morning? Sudarshan, let me begin with you.
Well, Z is a buying opportunity. After that sideways range, it's given a small bullish pattern. But given the fact that the markets are cheerful, buy Z with a stop under 248. L&T is another stock that had a big rally. It's had a small consolidation and finding support. Buy L&T with a stop under 3,015. L&T Finance is my only intraday short. A very awkward bearish looking pattern has emerged. I don't know why. Anyway, intraday short with a stop above 143. And finally, Indian Hotels is a buy. You had that handsome rally, one-sided rally, a consolidation, and probably a resumption of the rally. Stop under 414.
Okay. Mitesh, what about you?
Morning, Prashant. More buys to one sell. I think I have a buy on Asian Paints with a stop at 31.10 for targets of 3,200. HDFC Bank, after a long time, comes on the buy list. So that could, possibly see the Bank Nifty recover some of its underperformance against the Nifty. So HDFC Bank is a buy with a stop below 1520 for a first target of 1560. And a buy on GMR Infra with a stop at 5875 for a target of 65. I have one sell, that's Chola Finance. If it breaks the support range of 1090, 1085, go short with a stop at 1105 and look for a target of around 1040.
Mitesh, before I let you go, just a quick word on CG Power. Any thoughts? I mean, Wednesday we had that 20% move. Then there was a big throwover on Thursday, and Friday we ended about 7% lower on this one.
So I think it was news driven, but what is important technically here is that we had a highest ever weekly closing for the stock on the 8th of September around 455, and now I think the next breakout will come once we see a daily closing at least above that level of 455. So till that happens, you will see some profit booking happening at higher levels purely because the medium-term charts are very overbought. The stock has had a phenomenal run this year, and around the previous swing high with the overbought positions of indicators, I think there is some profit booking happening.
Okay, let's do one thing. Let's take a short commercial break. On the other side of the break, the pre-opening rates. We'll also talk about the pharma sector. Nithya Balasubramaniam of Sanford Bernstein will put focus on Cipla. Remember last week, the Indore manufacturing plant got a warning letter from the US FDA. But then there was buying interest in the stock as most brokerages have been positive. So we'll tell you what you should be doing with that one in just a bit. Stay tuned.
Okay, welcome back. Let's just take a quick look at what the pre-open is going to look like. I think we got a minute more to go, so perhaps just a minute more to wait. We're coming out of the long weekend, and as we've been saying, no big price action really to react to. The Nifty is here, has been range bound, and it's not as if, the US markets have directionally moved in a substantial way. Nothing really happening across the global screen as well. So what do you do from a futures and options perspective? Sneha Sheth is a derivatives research analyst at Angel One. She's with us. Sneha, good morning. Good to have you with us here. Thanks very much. What's the setup looking to you, and what would you advise viewers to do?
Very good morning, Prashant. If you see, Nifty has closed around 19,800 mark, and today's global setup looks a little positive. Apart from that, if you see FI's activity, they have added recent long positions in last two sessions. Apart from that, the long short ratio, which was around below 20, that has also improved slightly to 23 now. In put options as well, if you see decent writing, the put writers have shifted towards 19,800 strikes. So that is again a positive thing. Banking index also participated on Friday's session. So considering all this thing, I think the momentum may continue. However, 19,900 mark for Nifty and 44,000 mark for banking index is important resistance. So any move beyond this shall trigger some momentum. Until then, again, we should be focusing on individual counters. If you look at
Go ahead.
Yeah. So individual counters, if you see metal space did quite well. So we have a buy on JSW Steel. Here with a strict stop loss of around 769, we are recommending buy for the target of 800. Apart from this, from banking space, Bandhan Bank, here the reservoir ratio looks quite well. There is a good support zone around 210 odd levels. So I would recommend buying this counter also with a strict stop loss of 207, and the target expected is around 224.
All right. Thanks a lot, Sneha, for that. Have a good day. That's Angel One. But let's move on. Last week, Cipla was in focus. The Pithampur unit last week received a warning letter from the US FDA highlighting data integrity issues. The stock fell a bit, but then there was buying interest in the stock. A lot of brokerages came out and said that Cipla has seen very strong growth in its fundamentals lately, so they are bullish there, and they're not too concerned about this US FDA, warning letter. Nithya Balasubramaniam, the Director Healthcare at Sanford Bernstein, joins us now to discuss what she made of it. Nithya, I think the street used this as a buying opportunity, as a good opportunity to perhaps accumulate more of the stock. Is that the right way to approach it?
That's our view. we think the risk of an import alert, which is what seemed to have concerned investors last week, we think that is insignificant. See, typically when FDA gives a warning letter, the company has 15 days to respond to the warning letter with what they intend to do in terms of corrective action and preventive action. And on receipt of that, FDA typically, again, gives the company time to work on these action plan and then re-invite them back for a reinspection. And this can take anywhere between 6 months to even a year. Right? Post which, of course, when FDA comes back for reinspection, it depends on what they see at that point of time. So I think the immediate risk of an import alert is rather low. And you have Cipla's own example, right? If you look at the Goa plant, they had a warning letter. They were able to re-invite the FDA. They got additional 483s and they're working on it and they're going to re-invite them again. So I think the risk that the market seem to be worried about, we don't think exists. And even if you're looking at specific products and the impact, let's say there is an import alert for whatever import alert, and albuterol and butasanide are the two products which are supplied from that facility. We know that albuterol is also supplied by Cipla from the US facility. So even if the worst does happen, they do have an alternate filing.
Nitya, hi, morning. But do you think, looking at the contents of the letter, exhaustive corrective action will need to be taken? So that's the reason perhaps why many are worried that this is going to take longer than longer in terms of resolution, and of course then the import alert sort of, that's of course, as you say, it's unlikely according to you at this stage. But your thoughts?
See, in terms of what we saw in the warning letter, there was nothing incremental in terms of the observations, right? So these observations and the 483 form was made public several weeks ago, and we didn't see anything incremental. But what we did take away as incremental from the letter were two things. So one is they did explicitly ask for a CGMP consultant to be hired while Cipla is implementing the corrective action plan. And that is something I think Cipla would have done anyway. But in general, in some of the other warning letters, we have not seen this explicit ask. And the second is they highlighted that there were some repeat observations when they look at the observations they had given for Goa. So the letter seemed to now expect that it's not just indoor facility that Cipla needs to work on. They will have to make some interventions at a management level to make sure that the SOPs and implementation spans across the various facilities supplying to the US. So to that extent, I think there is an incremental expectation from FDA on what Cipla needs to implement here. And what we understand from the management is that for Goa, they are apparently ready in terms of the implementation having been done and therefore ready to invite the FDA back. And they're hoping that'll be in the first quarter of next calendar year. Now, my view is that even when they come for Goa reinspection, they're likely to want to see a more firm-wide transformation in terms of the SOPs and procedures.
Okay, that's about Cipla, but I wanted to talk about the rest of the industry as well, because there's a big outperformance that the pharma industry has seen this year, right? I mean, the Nifty Pharma Index so far in 2023 is up 27%, while the Nifty itself is up 9%. Do you think that outperformance is something that can continue? And ex of Cipla, which are the other companies that have both, you know, some valuation as well as growth headroom?
See, we think the run-up in the stocks were fully warranted given the kind of softer pricing environment we're seeing in the US. And we have seen substantial gross margin expansion as well, right? I think earnings bet most people's expectations this quarter on the back of, again, softer pricing, API and raw material cost recovering, you had freight cost recovery. So I think all of the reasons are why we saw the run in the sector. As to, I think in the next couple of quarters, it's likely to last because, again, YOY, things were weak, and on the back of that base, we continue to expect growth. In terms of US generics, sitting here today, I'm not seeing any incremental headwinds, and therefore, I don't believe why price erosion should go back to the 15-20% levels. But that being said, competitive intensity still remains high in the US. So any new launches that you see, or again, seeing 11 to 15 players participating, which means the 90-95% erosion that we have seen in the past is likely to stay. So companies, again, only with a strong pipeline or differentiated products in the pipeline are likely to do better than the others. So we think at least for the next couple of quarters, we would expect this sort of growth numbers to sustain. In terms of who we like beyond Cipla in the near term, if you're looking at the next couple of quarters, we think there is still room in Aurobindo. Again, very exposed to the US, and therefore the tailwind that we're seeing in the US is likely to support. We like Gland as well, similarly exposed to the US, and in addition, shortages in injectables is likely to last. Right? So the competitor has said that even going into first half of next year, they will struggle to supply. So Gland, therefore, is again likely to benefit given that valuations are reasonable, and of course, we did cover Cipla.
All right. Nitya, appreciate your thoughts. Thanks a lot for joining in. That's the call on the pharmaceutical space. But let's do one thing. Let us get, the pre-opening rates, which are looking very good, actually. The Nifty looks like it's going to open above the 19,800 mark. And a lot of individual stocks, Adani Enterprises, Power Grid, Adani Ports, Ultratech Cement, BPCL, all topping the charts this morning. Nimesh is here with us to give us the standout brokerage report of the day. Nimesh, what do you have?
Hi, Sonia. So today's standard is on OMCs, a big upgrade from HSBC and all the three OMC stocks. So they've upgraded the stocks to buy from hold earlier, and they've sharply raised the target price on all the three OMC stocks. For BPCL, HSBC has raised the target price now to 555 versus 340 earlier. On HPCL, they've raised the target price now to 375 versus 215 earlier. And on IOC, they've raised the target price now to 130 versus 80 earlier. Now, the key reasons for the upgrade, HSBC believes that the first half performance was quite strong for the OMCs, and that has improved their cash, their free cash flows, and have driven the book values as well. Also, they see decent, defining margins for OMCs going forward, and the support for the OMCs to continue by the government. So that's going to help the OMCs. On back of this, they've raised the earnings estimate for FY24 and FY25 for all the three companies. For IOC, HSBC raised the estimates by almost 58%. For HPCL, they've raised the earnings by 40%. And for BPCL, they've raised the earnings by as high as 76%. So on back of strong earnings and the fact that the government support could continue, a big upgrade on OMCs by HSBC, all the three stocks upgraded to buy, and massive target price increase as well.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's get Sudarshan back in for his 9:10 call. Sudarshan, please go ahead.
Well, consider buying Indian hotels with a stop under 414.
Got it. Okay. Mitesh, your 9:10 call?
I'll go with the buy on HDFC Bank for a target of 1560.
All right. Ekta is joining us now to give us the momentumizer stock of the day today. Ekta, over to you.
Thanks for that. Well, I'm looking at Macrotech Developers from the real estate space. It listed in April 2021 with an issue price of 486 odd rupees. It is up 83% from that issue price. The stock, in fact, closed very close to its 52-week high of around 895 odd rupees. The stock is up 151% from its 52-week low of around 355 rupees. It is a part of the S&P BSE 200. Now, in terms of the Q2, it was quite a strong quarter, like it has been for a lot of the real estate companies. So, for example, Q2 is generally supposed to be slower for real estate companies, but they saw their best ever pre-sales for the company at around 3,530 odd crores. They saw their net debt reduce in the quarter as well. And in terms of the business development guidance, the company's already achieved 80% of their annual guidance as of the first half of the fiscal. So it seems as though it is firing on all cylinders fundamentally. So maybe it could reflect in terms of the stock performance as well.
All right, do note, Ekta, thanks very much for that. We will actually connect with the management of Macrotech Developers on Bazaar at 9:30 this morning to discuss the business outlook and how demand is shaping up. We'll touch upon some of the things which Ekta highlighted as well. Well, let's actually talk about another one. This is from the pharma space, so going back to that, but hospitals more specifically. Fortis is the one I'm talking about. And here as well, I think there is a bit of a upgrade coming through. Ekta, back to you.
Well, yes, good news. In fact, it is positive for both Fortis as well as Fortis Malar. Both of them are listed companies. Fortis is going to be divesting their entire 62.7% stake in Fortis Malar to a private hospital company, MGM Healthcare, for 128 crores in an all-cash deal. Fortis Malar is a 140-bed hospital in Chennai. Company says that there were some unresolved legacy issues which constrained further investments. It is positive for both because Fortis will now be divesting. It is looking to divest all of its underperforming assets and has been in the last 2 quarters. So they have also exited Chennai with this particular divestment. They divested another facility in Chennai in July for 152 odd crores. Now MGM is going to possibly benefit from this because they're going to increase their bed count in Chennai itself. So their bed count is going to rise to around 800. It is a south-based hospital chain which is very focused on advanced hospital care. Now Fortis Malar, remember, is a loss-making company, so maybe it is going into stronger hands, hence it could be a positive. Goldman Sachs has written on Fortis Healthcare. They have a buy call with a target price of 400 odd rupees. They say the divestment is a significant step in the company's ongoing portfolio rationalization strategy. The company still has 4 to 5 facilities operating inefficiently, could potentially divest some, and the company does have plans to add around 1,400 odd beds in the next couple of years. So that could be something to watch out for as well.
All right, Ekta, thanks a lot for that. Another stock, in case you missed it, is BSE. Now, the stock has had a very strong run. It's up 300% in the last 6 months. But Jefferies this morning has initiated a buy. They have a target price of 2,700 on BSE, which is well above the current market price. It's almost 25% higher than the current market price. They talk about how the exchanges are benefiting from financialization of savings. The company can leverage macro tailwinds and derivatives. The derivatives market share has jumped quite a bit to 14% from less than 1% in the last 6 months. So, you know, BSE is one stock. They also talk about how monetization and continued growth is something that can lead to a better stock price as well as better earnings growth for the company. So keep that stock on your radar. Let's just head into the market opening now. Remember, Paytm is the other stock that you should be looking at this morning. Berkshire Hathaway has exited Paytm entirely. They've sold their 2.5% stake. This is a CNBC-TV18 exclusive, so that's another stock that perhaps will be the focal point for the day. But apart from that, the market has been largely range bound, but it could be volatile in the next couple of days as we have the exit polls on Thursday and the final results on Sunday. Broader market outperformance is something that the street is looking forward to. Remember, there have been big moves in insurance companies and PSU companies. BHEL, HAL were the top gainers last week. So perhaps that's something that can continue. Real estate has been in focus as well. So there is plenty of fodder for this market, no two ways about that. There's also F&O expiry that we're looking at this week. There's the MSCI rebalancing. So there are definitely a lot of cues that this market has to reckon with. That 19,800 mark is a bit of a resistance for the market, so let's see how it shapes up. But here's the first take on the index. Not too bad. It is up almost 35 points. So as we said, that it's sticky, that zone 19,800 to 19,830, but still a positive move for the market. Adani Group stocks are doing very well, so get them on board. Adani Enterprises and Ports are both up in the green. In fact, Adani Enterprises is up almost 4% right now. There was that big positive brokerage report on oil marketing companies. So BPCL is your top gainer, up 1.5%. Nimesh was just talking about that a while back. Hindalco, Power Grid, Eicher Motors is the other one, up 0.5%. In fact, auto stocks have been doing very well. So Eicher Motors, Hero MotoCorp, all trending in the green right now. Couple of other names, Axis Bank, Apollo Hospitals are also in the green, and something like an HDFC Life and SBI are holding on to the green line as we speak. On the downside though, you have SBI Life. Reliance is dragging its feet just a tad bit. ICICI Bank, Cipla, L&T and M&M are a couple of other stocks that are trending in the red. But largely you'd have to say the mid-cap index is the one that's outperforming yet again, while the frontliners are largely quite flat.
Well, that's right. So, the broader markets, there are a few stocks that are doing quite well. You have Kesoram Industries. Street is hoping that there's a deal in the offing. Large volumes in the first minute itself. We'll have to see how the deal is structured, if at all there is a deal. For the time being, they're saying they're looking at various measures to bring down their debt as well as prepayment of sub-debt. So that's one stock in focus. NetWeb, well, that's not a very large company, but they've collaborated with NVIDIA to unlock potential AI and high-performance computing. I think this release came in just earlier this morning at around 7:40 a.m. So that stock as well is up close to around 10% as we speak. So keep an eye out on that one. Insecticides India, well, that's up close to around 8.5%. You have Adani Total Gas as well, that's flying away. That's up close to around 7% odd. So plenty of movers actually from the broader markets, particularly on the upside. We're seeing a good amount of traction out there. On the flip side, let's focus on some other big movers. Then you have a couple of stocks that should come up for you on the screen. I think Honasa is seeing some bit of profit taking. That's down close to around 3% as we speak. has been a big move in the last couple of days, but giving up some part of what it put on. Prashant.
The big volume-led gainers are in the Adani name. So Adani Enterprise is up 3%. It'll come up on your screen, 22.94. Then it's followed by Adani Power, which is up 5%, and it's got tremendous volumes as well at about 418. So large gains there. BSE, we highlighted that 4%. Stock had gone to about 2,500, then sold off to a little over 21, back at about 2260. That's a 4% move on BSE Limited. HPCL is up 4%. HPCL for the month so far, as of last Friday, was up 30%. So this is a significant move coming through on HPCL. I think there's a Morgan Stanley call as well. They went on a marketing roadshow in Singapore with the HPCL management. And they're talking about a $5 billion EBITDA roadmap for HPCL. More on that later, but this is a big one coming through. And of course, that HSBC call that we highlighted earlier with Nimish. Adani Green is up about 4%, stocked at about 971. Adani Total is up about 7%. So yeah, there's a lot of Adani group stocks which are coming up. Wilmar, for example, is another one which is up about 3.5% as well. Sirma is another one, 2.5% higher, 573 on Sirma. HBL Power is up about 3%. Dredging Corp is up 3%. Kesoram Industries, of course, we sort of highlighted that story with Ultratech perhaps eyeing Kesoram's assets. Now seems like Adani perhaps is in the fray, if you believe news reports. 5% on Kesoram, and it's coming up. Volumes are still low for this point in the day. On the downside, if you remember all these insurance stocks, right? New India, you had GIC RE, they'd all surged 5-10% on Thursday and Friday. LIC was up 10% on Friday. There is some pullback. GIC RE is down 2%. New India is down about 1.5%. So nothing large, but a little bit. And of course, Nigel highlighted Honasa, which is down about 3% or so at this point in time. So 32 points is what we have. 19,830 is where we stand at.
Just one more stock, Orchid Pharma. There's 2.5% equity that's changed hands, so just keep an eye out on that one. There's just one notable higher than volume that I saw. So, it appears because of that large trade, we have a big move out there.
All right. So keep an eye out on that one. We'll come back to more names as the day goes along. There'll be more in the mix about 10-15 minutes later. But a market master of the day is ready with us. Vineet Sambre is head of equities at DSP Investment Managers. Vineet, good to have you with us here. Thank you very much for your time. Good morning. The two sort of consensus, in a way, themes which were supposed to work out. One, that large caps will start to do a lot better than mid and small caps. And that this is the time now for financials because there is a large margin of comfort there. So far, the market in its collective wisdom seems to be ignoring both these sort of beliefs in that sense, Vineet. How long, you think?
So Prashant, I think it's very difficult to call out the timings of each of these segments. But, as you know, whenever the markets actually are in, they are backing a specific fancy or a specific narrative, I think it tends to get extended, and which is what we are witnessing right now when it comes to maybe some of these small caps or some of the themes which are just doing well right now. And at the moment, like you mentioned, the large caps are getting ignored. The banking sector has seen, we were just looking at some of the, doing the analysis for the banking sector. Last 4 years, it has underperformed the Nifty banking index has underperformed the Nifty overall. And if we take collectively last, let's say 5 years or 6 years return, Nifty banking has, on a 10-year rolling basis, has always outperformed the Nifty overall return. So I believe it's a matter of time as the fundamentals start, people start focusing on the fundamentals. The banking sector generally is in good shape right now. Maybe a quarter or two, once the concern around the peaking NIMs goes away, I think that's where maybe the banking sector starts to do well.
Okay. Vineet, hi, it's good seeing you after a while. And this entire space, the mid-cap and small-cap space that you've been tracking so closely for the last so many years is now started to outperform quite a bit. Are there any themes or spaces, sectors that you like from here on? I mean, so much has come back in a big way, whether it's real estate, whether it's renewable energy, whether it's electric vehicles, newer themes. What's your focus area now?
Yeah, so I think few segments. So as the valuations keeps rising, and as the stock prices keeps going up, the opportunities also from the valuation perspective keep receding. So I mean that is one fundamental viewpoint. But at the same time, when we are actually looking at a few segments, we still believe that the visibility of growth in terms of the earnings for some of these segments are good. And despite the valuations maybe at some premium, it is okay to hold on to some of these segments. So in that view, so I think healthcare is one category which I have been bullish about and has started performing. There we are seeing margin expansion leading to earnings growth, which I believe is a good segment to be over the next 1 or 2 years. I see that the category should continue to outperform. It has seen underperformance for the last 1 to 2 years. Banking, as I said, across the NBFCs and the banks, I think it's a good place to be in. Maybe 1 or 2 quarters should be a good time to accumulate some of these categories of stocks. The other bit is the consumer discretionary, and we have seen that the segment has underperformed for a while because of the low demand environment. Now, my sense is that it has been a good 1 year long period where the consumption has been slow, and my sense is that as the inflation has hurt the pockets, the real adjustment should start taking place. And consumer discretionary is something which we are incrementally looking at good companies because we are believers of long-term consumption story in India. And then, few themes which I always like. Agri is one thing which I like. Building material is one thing which I like. And now more so because the real estate is doing well. So I think these are some themes which one can actually look at when it comes to good visibility of growth in future.
Okay. Hi, Vineet. Good to see you in. Vineet, after a while, we've got a lot of interest in the IPO market and from the Tata stable as well, Tata Technologies. Big interest out there. There are some listed peers as well, so to call it, ER&D players, and some of them have as such done well. What's your view on the IT and in particular the ER&D space?
Actually, we have exposure to ER&D space, and in our mid and small caps, I think we have a good amount of exposure there through one of the small cap name known as C&. So we have a positive view. Overall, I think when one is looking at the overall slowdown as far as the IT services are concerned, ER&D may be placed slightly better in terms of the growth prospects. And I think even the long-term prospects for some of these companies are looking good. Now depending upon what type of companies we are talking about, there are some segments within the ER&D which were slow. Let's say the aviation related business. I think those should start picking up now. And again, depending upon the mix of the companies trying to target those, I think they should do well. So I think overall we have a good view on the IT with a long-term view. Maybe the near-term may be slightly more slow. But on ER&D, I think we are generally bullish is what I can say.
Fine.
And by the way, the Tata Tech IPO, of course, lists. The listing is the day after tomorrow. Thursday is the Tata Tech listing, so that'll be closely watched as well. Isn't it? Vineet, on the agri side, so what? I mean, could you be a little more specific? What do you own there, and what's the call? What kind of names really? Is it agrochemicals you're referring to, or sectors dependent on that segment?
So actually, we have exposure direct agri plays through both agrochemical and fertilizer, and I think there are decent sized companies out here doing good business. My sense is that agri overall, if you look at the framework here, we are the second largest agricultural economy in the world. And when it comes to the overall arable land, we just have about 50% of our arable land which is irrigated. So I believe that there is a huge amount of opportunity which is there as far as the agri business is concerned. And when we look at the companies both across the fertilizer and the agrochemical chain, I think as I mentioned, there are good leading companies out there doing well, good market shares. So I think that over the longer term, I think these companies should start doing well. Right now, at the moment, we had seen agrochemical go through slightly, a slow environment in the last 1.5 year. they were facing high raw material price environment, and so I think those are normalizing, and I think over the next 1 or 2 years, agrochemicals should start doing well. Is my sense. Fertilizer is a bit more stable, is what I can say.
Okay, agrochemicals should start doing well. Got it. Thanks a lot, Vineet, for joining in. Have a great festive season, and hopefully we'll get to speak to you again very soon. That is the word coming in from Vineet Samre of DSP Investment Managers. But the market is just sort of ambling. Nothing much is happening. It's very, very quiet, just holding on to 19,830. The Bank Nifty has dipped slightly into the red, but it's really nothing alarming. Gives us some time to talk about individual stocks. Macrotech Developers is on our radar. The stock has been buzzing. This month, it's up 17% so far. And to discuss the business momentum, how demand is shaping up, Prashant Bindal, the Chief Sales Officer at Macrotech Developers, joins us now. Prashant, thanks a lot for joining in, and greetings of the festive season to you and your team at the Lodha Group. I want to start by asking you about what the development is in the Palava project. How is the demand at Palava so far? And how much of the 4,000 acres of land has been used for development? How much is yet to be developed? If you can just, tell us what the plans are.
Well, the overall momentum is there across the segments, and Palava is our flagship business for the affordable segment. And like all the businesses are doing well, Palava business is also doing extremely well for us. And we have diversified there into the affordable segment and also the aspirational segment, and we are getting and also into plots. In fact, plots has given us a great momentum there to upgrade the overall Palava experience. So the overall Palava, we hope to be close to 1,500 crore business this year, which will be very significant. And as far as 4,000 acres is a large land parcel, and we are also developing our warehouse business there. So we have got enough land parcels in excess of more than 2,500 acres, which is still available with us to develop in the course of next 5 years. And we believe that Palava is going to continue to perform the way it has done for us in the last 5 years, and especially last 2 years.
So you said 1,500 crores is the business that you're expecting this year in FY24 from Palava. Can you tell us in FY25 what kind of business are you expecting, and what's the value of the unsold inventory currently in Palava?
See, the unsold inventory is not very high. We expect a 20% growth overall in our business, and we expect 20% growth at Palava also. In terms of the overall, is close to about 1,000 crore, which is very normal for such a large scale of business. And we are doing almost 500 crore worth of ready-to-move-in sales every year in Palava, 400 to 500 crore. So we have not more than 24 months of ready-to-move-in inventory in Palava. Which has moved very significantly as soon as in last 3 years, the number has come down very significantly.
Prashant, hi. Good morning. So that is unsold inventory which is ready to move in. That is small, as you said. But what is the total developable area? As you said, it's a very large piece of land.
See, ultimately, if you have to do, it goes by the rule that if you have to do a 1,500 crore business in any project, we must have at least 2,500 crore worth of inventory available to do that kind of a business. So, so that is the kind of inventory we always keep, so that a business of almost 1,500 crore to 1,800 crore can be achieved. So about 1,000 crore is the ready-to-move-in inventory, and the under-construction project is also around of the same size, about 1,000 to 1,200 crores. So this is the kind of inventory that will always be available in Palava, and as the business moves from 1,500 to 2,000 crore, we will need to have more inventory available to us to deliver that kind of a business.
Okay. So just to repeat, I mean, what is in terms of developable area? What would it be in million square feet? I mean, if you can give us a sense overall over the next many years. Second, there was a Kotak report about the Palava project. They were talking about new sort of infrastructure projects, better connectivity, etc., which may bring the gap between prices prevalent there and prices prevalent in Mumbai closer. So prices right now, according to Kotak in Palava, are about half of what builders are able to charge here, or maybe in the suburbs, etc. So can you give us some sense of that?
Absolutely. The key is, see, for example, anyway, the prices have moved significantly forward in Palava in last 2 years. And also the kind of housing that we have diversified from hardcore affordable segment to also aspirational segment and also in premium segment. And we have seen very significant plus getting from the plots. Now, as the infrastructure, especially say, for example, the Katai road network that connects it to Airoli. Say, for example, Kotak was very right. The prices available in Airoli are almost 70% more than that of Palava. Now, as the network gets converted and hopefully in next 3 to 6 months, the connectivity to Airoli becomes much easier. And that is where the biggest opportunity of all these infrastructure projects is, where the connectivity becomes so easier and the kind of product availability in Palava, the prices are bound to go up to that level, and the ability to extract that kind of of pricing which are available in the suburbs or even in Airoli is what we are banking on, and we hope that in next 6 to 12 months that would be a real possibility.
So can you give us the exact number, both in Palava, in this Upper Thane area? What kind of pre-sales and collections are you expecting over the next 1 to 2 years here?
See, for the opportunity is that this year we hope to, in Palava and the overall Upper Thane area, we hope to get about 2,500 crore business. And of course, a 20 to 25% growth every year. That is what our expectations are in next 2 years. Our overall, guidance that we have given is that overall business also continues to grow about 20%. But these are existing business, and here also we expect a 20% growth in year to year, for at least for next 3 years.
Correct. Hi, Prashant. Morning. Good to see you in. Well, you have around 6 million square feet of warehouse assets under development. How does the income stream work here? What are the rentals?
See, it also, the key is, first of all, the opportunity is to expand the overall scale of it. The rental part comes, yes, it is effective piece, but the key is first to get the scale. And considering the kind of business, the kind of opportunity, land opportunity we have. For example, Skechers has built us the biggest, warehouse in the country in size with us. And these are the kind of opportunities that are coming there. So the key is first to build the scale. And once the scale starts happening, then the rental scheme, we expect about 500 crore business coming from this scheme in this year. And we steadily hope to build it to close to if your overall business growth is expected to be 20%, this is one business where we expect to grow it by double that percentage.
Okay, got it. So, I just want to understand a little more about, I didn't get the numbers, sorry. What are the kind of rentals that you're looking at, say, over the next 18 to 24 months from this 6 million square feet, the exact number?
See, the overall expectation is that if we convert it into business sense, about 500 crore worth of convertible business is expected this year. And we expect that next 30 to 40, next 3 to 4 years, we expect it to grow it by 40% year after year.
Okay, so 500 crores worth of convertible business in the first year from this 6 million square feet of warehouse assets under development, right? That's what you're expecting.
Yes,
got it.
yes.
There is this JV for digital infrastructure as well, a digital infrastructure platform. I think this is something that you did last year. So can you tell us what is the outcome? Are you looking at launching a
Actually, this highway business is basically the same as the digital infrastructure piece. This is how we are looking at it. This is the same as what we are looking at. The development of this area of digital infrastructure is what we are looking at in this kind of a business. It's the same as what you mentioned about.
Okay, so overall, from the Palava land parcel, you said we should expect for many years to come between 1,500 to 2,000 crores of sales every year.
Minimum. This 1,500 crores this year, a consistent growth of about 20% every year from the residential piece, and from the digital infrastructure, as you say, a consistent growth of another 500 to 700 crores coming. So together, both holding us about 2,500 crore business combined is what our expectations are.
Okay, and in the facility management business, what is the kind of growth? I think you said 400 to 500 crores by 2030. Can you tell us what's the current size of this facility management business? And in the first 2 years, right, FY25, FY26, what kind of growth are you expecting?
See, as you see, first facility management, where do we? The opportunities are huge, and we are building our own operations because we have close to 55,000 consumers staying in our houses and about 15,000 people staying on rent in our houses. So that's a huge opportunity of building a facility management exercise. The first is build the scale, and as we are continuing to build the scale and give them the services. So the first, that is why I said at a 5-year perspective, that kind of a business is really possible. The first 2 years, it is not the revenue stream, but the building up of a scale and the kind of services we can offer in facilities management. So in that perspective, it may not look huge numbers currently, but they will scale up very significantly once the overall scale of the services that we are able to provide to the consumers that we are connected with. So first 2 years may not look very significant in terms of value, but in terms of building up of a scale, they may act as a bridge to a fairly significant business in coming 5 years. That is why I gave a 5-year perspective.
Okay, we will let you go on that note. Thank you. Very informative discussion there, and all the best with Palava. You have some ambitious numbers there. Hoping to get 2,500 crores of sales from Palava and the Upper Thane area. Let's do one thing. Let's take a short commercial break. Market is still very quiet, but on the other side of the break, we will speak with Anuj Khandelwal of JK Cement, someone who rarely talks. We'll get him to join us to talk about their new cement manufacturing unit in Madhya Pradesh. Later in our special segment, Charting Trends, Sachidanand Uttekar of Trade Bulls will help us decode the charts and technical trends in the market and several other counters. Stay tuned.
Co-presented.
Welcome back. Well, let's focus on the cement space. We just talked about real estate. One of the raw materials would be cement. And JK Cement, well, that's the next company on our radar. They've gone ahead and they've commissioned their grinding facility in Madhya Pradesh, and that's on expected lines and on expected timelines as well. How do things ramp up from there, and how is demand as well as pricing moving ahead? Well, Mr. Anuj Khandelwal, the business head at JK Cement, joins us on the show. Hi, Mr. Khandelwal. Good morning, and thanks so much for joining in here on CNBC-TV18. Well, give us a couple of details with regard to this 1.5 million ton grinding facility. Where does it source its clinker from?
Okay, Nigel, firstly, thanks for having me on this segment. We are very happy that we've commissioned the Ujjain grinding unit of 1.5 million ton. It will source its clinker from our Rajasthan integrated plants, Mangrove, and that's where they'll get the clinker from.
Got it. Okay, all right. Fair enough then. And also, I think in the coming year, that's FY25, you'll have another 2.5 million ton grinding facility that will get commissioned. So that as well sources clinker from where?
No, so that will be in Prayagraj. It's a 2 million ton facility. Yes. It will source from our Panna integrated unit. So okay, that's in the eastern part of UP, so it'll be very distant to take it from Rajasthan. We have an integrated plant in eastern part of Madhya Pradesh, from where it'll send the clinker to Prayagraj.
Perfect. So, because clinker sourcing was something that the street had a couple of concerns on, but as you're clearing it out, the Prayagraj unit will source it from Panna, while the MP unit will source it from Rajasthan. Let's focus on volumes then for the year. When we had JK Cement in the past, when they joined us, they were telling us that because of the capacities that have come on stream, whether it is the Panna unit and the other facilities as well that will ramp up, the volume growth of JK Cement will be far better than what the industry is working with. For this year, what kind of volume growth are you looking at for JK Cement? That's FY24.
Yeah, so look, in the first 6 months, we've been, better than the industry. We've clocked 20% plus volume growth in the first 6 months or so. And, we target to end the year consolidated volumes of around 18 to 18.5 million, and grey cement volumes around 16 to 16.5 million. That'll be at a 15-16% growth versus last year. So that will be...
Right. Anu, just to comment, the consolidated volumes you said will be 18 to 19 million or 18 to 20?
18 to 18.5 million.
18 to 18.5, and out of that, grey will be how much?
Around 16 million, 16 to 16.5.
Okay.
You could take 16 million as a number, yeah.
Got it. Anuj, hi, good morning and thanks for joining in. Just a couple of more questions. What does this mean in terms of an EBITDA per ton from here on? Earlier, I think we were talking about 1,000 rupees per ton in the second half of FY24, but you achieved that in the first half itself, so congratulations. But can you build on to this 1,000 rupees in FY25?
Yeah, just a small correction. I think first half was 950 rupees. In Q2, yes, we reached 1,000 rupees, around 1,030 rupee per ton. But yes, look, we are looking at higher EBITDA numbers in H2, given the demand is likely to be good and our unit economics and unit profitability is also improving. So, we should definitely be better than the 1,000 rupee per ton guidance given in the H2 of the year.
Sure. Would you have any kind of number? Are you looking at 1,500 rupees? Just trying to understand, what the ballpark would be over the next 1 to 2 years.
So look, 1,500 is very far. We are at 1,000, but at least we'll definitely try to be at least 100 rupee a ton more than what we've clocked. So around 1,100 rupee per ton is what we'll at minimum target. But it's too early to give estimates. We've just started the H2.
Okay, all right. But 100 rupees per ton is par for the course, because in the past quarter you did around 1,030. So, I think going by what you're saying, maybe we work with around 1,100 to 1,150 rupees per ton, a broad range. Workable, right?
Yeah, hope so.
Okay.
Yeah, looks like that.
Part of that will have to be price increases. So, give us an update about how price increases have panned out in quarter 3, if I compare it with the average of quarter 2. And also, premium sales, I think they were low teens as a percentage of your trade sales mix. Where do you see that number headed, say, by the end of FY24 and by FY25?
So, Nigel, so look, pricing is very region-centric in cement, right? So,
yes.
We've also seen that playing out across our regions. In North, there has, given the kind of demand which has been there due to the pre-electoral kind of activity, essentially, we've been able to take around 10 rupee per bag on an average. Of course, it also varies within North, but at least 10 to 15 rupee per bag we've been able to take in North. In Central, given high competitive intensity, the prices have remained flat. And in South, again, because we were off from a low base in terms of pricing, we've been able to take around 15 rupee per bag. So overall, you could say around 8 to 10 rupee per bag, on an average we've been able to take.
And premium sales, you wanted to mention that as well as a percentage of your trade sales?
Absolutely. So premium sales right now is around low teens, as you said, 12% or so. By the end of FY24, we would want to take it to around 14% and maybe in FY25 target 16-17%. We are going in a very...
Got it. I don't know.
Methodical way because...
Okay, there's, I think, some issue with your video. Okay, I'll try again, but that's great to hear that you're looking to for higher amount of premium sales. Any kind of inorganic growth plans that you have? If yes, what would they be? Would that put any pressure on your debt?
So look, we definitely look at opportunities, but it's very difficult to plan around inorganic growth, right? Because the opportunities, will come when they come. So our base case plan is, of course, organic growth, and depending on opportunities, we are open to inorganic growth. As far as debt goes, look, right now our net debt to EBITDA, the ratio which we kind of look at with more precision, is around 2.1 or so. We want to definitely bring it below 2. But at the end of the day, we also want to create a healthy balance between debt reduction and growth. Because if we go for very, very aggressive debt reduction, it will also hamper growth. But on the other hand, of course, for obvious reasons, we also don't want to be very high on debt. So while it is 2.1 net debt to EBITDA right now, we want to bring it down to lesser levels by the end of the year.
Okay, so you want to bring your debt down, net debt to EBITDA lesser levels, got that. But the reason I was asking about inorganic plans is because you have this target, right, of 25 million tons by 2025. You plan to achieve it through the organic route itself, or at some point you would, want to, because it's not too far away, so which means you would have to do some inorganic moves in the next 1 year itself.
Not necessarily per se, because look, we are, before Ujjain, we were 20.7, right? And this is just grey cement capacity I'm talking about. With Ujjain, we are at 22.2. With Prayagraj, we'll be at 24.2. So, 24.2 million tons capacity we reach before the end of next calendar year. So, the plans per se are not dependent on inorganic opportunities, but having said that, we'll always keep our eyes and ears out.
Okay, and but I'll tell you what, the reason that we are asking you, Anuj, is because I have my ear on the ground, and I believe in the next 4 months is going to be very interesting for the cement space on the inorganic front. I believe that a couple of transactions will close out. Have you looked at it? Have you heard about a couple of units, say in the vicinity of 5 to 10 million ton units on the block? Have you all been approached by bankers? Are you all in any kind of discussions?
So too premature to tell that, but yes, we get opportunities, we get approached by the bankers, but too premature to talk about it.
Any region you want to tell us? When you all have been approached?
Maybe in our next call, yeah. But let me just clarify that our base case plan is organic growth.
Got it. Yeah, and you all have maintained that as well. On the debt number, would you like to give us a guidance? Because, you all have indicated that around this 3,100 crores, you all have topped out on debt. And maybe things will, you'll see some kind of debt reduction from here. So has debt topped out? And also, what is the capex plan for this year? I think it was around 1,300 to 1,400 crores for FY25. Have you all revised that number?
No. I think the numbers are, from the capex perspective, are quite consistent. We've, one of the big, of course, when you look at the 1,300 crores, of course, there was completion of Panna capex, which has already happened. Ujjain commissioning was another a big capex, which has already happened. Our, capex plans on Prayagraj unit is underway. Plus a few more capex, capex items like waste heat recovery system in Muddapur plant is already on the way. So we've remained consistent on our capex guidance, and that's how we've progressed.
Okay. Just before we let you go, this recent foray that took place into the paint sector, it's very interesting. Just tell us a little bit about that. What is the kind of revenue ramp up that you're expecting? When can we expect break even? Because this is a very competitive space as well.
So look, I don't lead the paints business, so I might not be the best place to talk about it, but I can at least tell you that it's off to a good start. We've ramped up in a few states, UP, Rajasthan, etc., and we've got good initial success from the channel. So, but look, we are in the growth mode, and the break even, etc., might happen, maybe a year or two down the line. But as of now, we are very cognizant of how much burn we do there, and given whatever our plans of our commitment on investment was there, we are sticking to it. We are not. We are quite disciplined about it. But more, more details, I think, I'm not the best place to give.
But we appreciate you joining in, Anuj, and giving us a fair bit in terms of an outlook out here. Sourcing of clinker, you have cleared that with regard to your expansion plans. You're looking at around 18 million tons for the year on a consolidated basis. And the EBITDA per ton number will improve by close to around 100 rupees per ton. Thanks so much for speaking to us here on CNBC-TV18.
All right, that's the word coming in from JK Cement. But let's get into our special segment, Charting Trends. Sachidanand Dhikar, AVP Technical at Trade Bulls, joins us now to decode the market from a technical lens. Sachidanand, thanks a lot for being with us on the channel. I wanted to first start by asking you about whether this market is on the precipice of a breakout on the upside. And if yes, what are the levels that you need to watch out for from here on?
Good morning, Sonia, and thank you for having me on this particular segment again. Last time when we spoke, we were talking about Nifty in the consolidation band, and we specifically, pinpointed one particular oscillator, which is ADX. Now, the ADX placement was very interesting, and that's why we were confident that sooner or later, Nifty would see a breakout. And this is what we have already seen unfolding here. If you look at the monthly chart of Nifty, we are about to close the month of November on a strong note. If you look at the formation, it purely looks like a bullish flag formation. The entire construction is indicating a very strong secular bull run to again evolve. We're expecting a price target somewhere close to around 21,400 eventually. Now, if you look at the base of this particular pattern, which formed almost around 17,300 in the month of April, May, from there we saw a very strong lift off, and post that, we saw a swing towards 19,900. Then we saw the Nifty, consolidating for almost 4 months. So it was a 4 months up move followed by a 4 months consolidation. from a price and a time perspective, this particular pattern looks very confident, and that's why we believe that the 19,900 hurdle, which has been facing a lot of resistance in the last particular couple of weeks, I think this particular hurdle will also get surpassed. If you look at the monthly ADX, it has been sustaining above that 25 level mark. So we are confident that sooner or later Nifty could scale towards 21,400. On a short-term basis, we are expecting a price swing towards 20,400 on an immediate basis, followed by 20,600, which could be seen in this particular coming expiry itself.
Sachinand, you have a view on the Pharma index as well, something we discussed on the fundamental basis earlier on. What's the view there?
Yes, Prashant, if you look at the structure on a monthly basis, it looks very confident. We saw a very strong breakout from a rounding bottom formation, somewhere close to around 14,700. Post that, we saw this particular index consolidating, and if you look at the performance of this particular sector during this particular month, it has been relatively very strong. So the entire sequence again looks like a bullish flag formation. Post the breakout from a rounding formation. So I think it's a cluster of multiple continuation patterns indicating the same fact that there could be some more upside left. So on the immediate basis, we may see a swing towards 17,040 from here on. The base looks very strong at 14,700. It was revisited during this particular series, and from there it has lifted off. So we're expecting this particular rally to continue. On an immediate basis, we may see Nifty Pharma scaling towards 17,040. But eventually, if you look at the rounding bottom formation, which is almost a 2 years pattern, it is indicating a price target somewhere close to around 17,700. So I think there's a good enough headroom on the higher side. And even here, from a momentum perspective, long positions can be chased.
Okay. Hi, Sachi. Morning. Good to see you in. And you're sounding quite bullish on the pharma space. I believe you have a view on Divi's Laboratories as well. Tell us the levels you're looking at.
Nigel, interesting structure. In fact, if you look at the sequence from April 2022, the stock was in a lower top, low bottom sequence, a bearish sequence, and it formed a bearish or a wedge formation on the lower side. From there, we saw a very confident, base in the 2023 March, where it started, changing its trend at around 2,700. And post that, we have already seen a very strong, confident rally. Now, recently, when we saw this particular stock, slipping towards 3,300, we saw it again getting support near its 200 weekly exponential moving average, which also coincides with the rising channel that has been exhibited in the diagram here. So the graph indicates that there has been a very strong vertical rally post that level was reconfirmed. The base looks very strong at 3,300, and the way this particular impulse is unfolding, we are of the opinion that we may see a Divi's lab scaling towards 4170 on an immediate basis, and that's why we are recommending building long positions here. From a level perspective, trading positions can still be considered here. Keep a stop loss somewhere close to around 3605 on a weekly closing basis, and we may see in a month or so this particular level of 4170 getting achieved.
All right. Well, just a couple of more, thoughts on individual stocks. By the way, BSE is really firing up now on the back of the Jefferies report. So just wanted to get that stock up on board.
BSE, and look at MCX.
MCX,
as well.
yes.
MCX is
And look at IX now.
All the exchanges are up and above.
We're in one by one each.
Pull up the underperformer, IEX. That one hasn't performed.
Let's have all three indices up, actually. All three exchanges, BSE, IEX and MCX. And IEX, of course, is the underperformer. The other two are the outperformers.
Yes.
IEX is up about 2.25%. You got BSE, which is up about 4.33%, and MCX. Jefferies, of course, came out with a note for BSE. MCX also, I believe there is a note this morning. It's up 7%, sharply higher, 3150. IEX, I think, is just a bounce off,
just
the sentiment.
Yeah.
But Sachidanand, any thoughts here? I mean, these are stocks. Of course, BSE has had a phenomenal rally. Any thoughts on any follow-on buying here?
I think BSE, we've already seen a decent correction. If you look at the way its price performance has been for the last 6 months. I think it formed a base somewhere close to around 540 kind of a level. Post that, it has really not declined or seen a closing below its 20-day exponential moving average. So even recently, when we saw this particular correction from 2400 levels, the correction got absorbed at around 2000, where its 20-day exponential moving average is placed. So I think the stock is in a very good, strong, healthy, bull run. Any slippages towards 2000, I think, should be a very good opportunity again to accumulate this particular counter from a portfolio perspective. We are expecting that this particular rally should continue towards 2800 eventually.
Okay, thanks very much, Sajanand. Great to have you with us here. Appreciate your time as always. Now let's just talk about flows, right? And there's one report which is doing the rounds, I think, which perhaps signals a large amount of inflow which could come our way. What am I talking about? A US federal government retirement fund. It's called the Federal Retirement Thrift Investment Board. It's one of the largest US government retirement funds. It's got assets of about $600 billion. Is looking to change its benchmark. I mean, funds benchmark themselves to indices like the MSCI Emerging Market Index, or the World Index, etc. And this one is changing its benchmark. And what this means is that markets which so far were not part of the allocation for this particular fund sort of come into the fold. India is one such market, and India is expected to be a large beneficiary once this adjustment, once this change takes place. We have Sriram Velayudan, Vice President, Alternate Research at IIFL Securities, joining in. Sriram, good morning. Good to have you with us here. Thank you very much. I trust you would have seen sort of the announcement from the fund itself. What do you make of it? And if you've been able to kind of put some of these in terms of the new benchmark, what this would mean in terms of reallocation and money our way, India's way.
Good morning, Prashant. Yes. So in one of their board meetings, the Federal Retirement Thrift Investment Board, as you rightly pointed out, it is one of the largest retirement pension funds investing globally. So the fund has decided to change the benchmark index from MSCI EAFE, so basically tracking Europe, which used to track Europe, Asia, Australia and all, to MSCI All World Investable Market Index, ex of USA, China and Hong Kong. So the objective of the fund in changing the benchmark was to, so the rationale that they have given on changing their investment benchmark is they wanted to expand their investment opportunities and also improve the risk return profile of the fund. So they had done some internal analysis. This is what the release from the fund suggests. Basis their internal analysis, the MSCI All World IMI ex USA, China, Hong Kong has outperformed MSCI EAFE over the last 20 years on a risk-adjusted basis. Also, the very fact that it also gives an exposure to broad basket of stocks across the emerging markets, which have given superior returns to the existing benchmark. So all this is behind, all these are the reasons behind the fund changing its benchmark to the All World IMI, ex-US, China and Hong Kong.
What does this mean? I mean, at the end of the day, for our viewer watching right now, he would only want to know what this means in terms of money coming into the Indian markets, right? And the reports indicate that it could be in excess of around $3.5, $3.6 billion. Is that a reasonable estimate, you think?
Yeah. So, good morning, Sonia. So in terms of flow impact, the specific category of fund which has an AUM of roughly $68 billion, so basis our estimation, we expect inflows of roughly $3.4 to $3.5 billion in 2024, spread over 4 reviews, because largely the document is silent on how it will work out. It will be implemented in 2024. This is what the official release suggests. Now the MSCI indices undergo review each quarter starting Feb, May, August and November. We expect same to be implemented. So 3.4 billion is our expectation for India, basis the inflows. So this is significant. This is significant because what we have seen over a period of time is India, on the basis of superior performance, has ended up adding more names. Even weightage of India in the MSCI Emerging Market Index is close to 16.2%, if I am not wrong. So let's say if the momentum continues in the Indian markets over and above the usual net inflow that we see in each review, this should add on to that inflow.
But this will be
positive.
Okay, $3.5 billion spread over 12 months, right? That's what Sriram is saying.
No, $3.5 billion spread over 4 reviews.
4 reviews, but these okay, but all 4 tranches will happen into 24.
Yes, correct. Right. Yes.
Yeah, that's what I meant. Yeah, through the course of the 12 months, 2024. Sriram, this would, if you were to divide this equally into 4 tranches, I mean, for context, what does this mean compared to average what we've seen in terms of what FIs have done recently? I mean, how significant could this be? Kind of filling the gap in that sense, some of this passive money.
Okay. So, Prashant, if one assesses in the last couple of weeks, I think the flows have started reversing, but overall FPIs have been sellers in the Indian markets. Largely in the last few months, this has changed. So as I said, India has been adding more names in the emerging market basket. To the best of my knowledge, the last 4 reviews on an average, India has seen inflows to the tune of $500 million to roughly $1.5 billion. We have our November quarterly review this Thursday. That is day after tomorrow. That again is a net inflow event for India to the tune of $1.2 billion. So in the overall context, as I said, let's say if India continues to outperform the other emerging market peers, this will add on to the inflows in the overall scheme of things.
Okay, all right. Well, always a good thing for our markets, right, Sriram? So thanks a lot for joining in. Inflows of $3.4 billion could come over the span of 4 reviews. Well, that's an important piece of information. Let's do one thing. Let us thank our guests for joining us and take a quick break. On the other side, we'll put focus on the commodity markets. Brent crude prices have fallen. So more on that coming up in a bit. Welcome back. Well, as promised, here is a quick update on what's happening in the world of commodities. Manisha Gupta is joining in to give us more on that. Manisha, over to you.
Thank you for that, Sonia. Well, November actually has been kind to commodities, where we are looking at most of them closing this month on a positive side. But I do want to talk about precious metals, because after trying hard for last 6 months, gold finally is now trading above $2,000 per ounce. The spot in the future markets for gold are trading at 2,000, 2015 on the higher side. So it has been a strong going there. That's what gold has done. It has gained 6.5%, almost 7% in the month of October, and is up 1.5% on the higher side for the month of November as well. It has been good going for silver as well. I mean, that clearly seems to be outperforming gold for the month of November. Overnight has been 1.5% gains, and for the month of November till time, it has been an 8% of a jump up that the silver prices are trading with. Well, it has been about the soft US dollar index, which is trading at a 3-month lows. That has been supportive for the precious metal prices. Also, it has been safe haven buying that has led to markets on the higher side. And then there is a CME Fed tool suggesting that even as minor, but there's a 25% probability now that the US Fed could cut interest rates in the month of March 2024. And that has led to that further investment coming in for this sector. I'll talk some more about silver first. And the global silver mining, when you look at that, has seen a drop of 2% in 2023 till time. While you look at the demand side of it, that is estimated 8 to 10% on the higher side. So you are looking at a deficiency in silver availability in the global markets. That mismatch has led to premium into prices. Also, when you look at the last year itself, well, 2022, we saw 18% of investment in physical silver at a record 329 million ounces in the previous year. And the silver prices gained up by almost 4% in the previous year. And this year has been supportive. For the gold prices, well, the investment buying has been strong here as well. When you look at the ETF buying, that has continued to gain for 2 weeks now. The World Gold Council shows that you have seen 1.5 tons of gold flow into ETFs there. Also, there is a Goldman Sachs report which says that their 12-month price target for the commodity now stands at $2,050 per ounce. Interestingly, there's a lot of data coming in this week. You have the ISM manufacturing numbers, also the personal spending, income. All of those numbers will further tell you on where the prices are headed. But most of the banks and brokerages are now talking about 2,000 plus kind of levels for 2024.
Okay, thanks a lot, Manisha, for that. Well, let's step into a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Ashok Kumar Tyagi of DLF and Prashant Thakur of the Anurag Group to talk about demand trends in the real estate sector. Stay tuned.
Co-powered by